Will interest rates finally start falling through the rest of 2024? I have no idea. Let's talk about it anyway. Hi, this is Eric Blattner with Divvy Wealth Management, and thanks for watching. Before we talk a little bit about interest rate forecasting, just want to remind folks that if you like to follow along with some of our thoughts on markets and planning and things of that nature, the best way to do so is head over to divvywealth.com/blog, and you can sign up there, or you can go over to YouTube and search at Divvy Wealth Management to subscribe to our content there. So with that being said, just as a reminder, everything that we talk about here is intended to be educational in nature. It's certainly not financial advice. Everybody's situation is different, so take that all into consideration as you're listening, please. Now, turning to the topic of the day, it's interest rates, and particularly direction of interest rates from here. The Wall Street Journal recently published an article with forecasts from almost 70 different economists, and they covered everything from labor markets to economic growth. But the piece that really, I guess, caught my attention was the forecast for interest rates. And there's going to be a chart that I link here or display in a minute. But I think the important thing to me was really taking a look back at where we've been or where we come from so far this year. And when we ended 2023, the general consensus was we're going to have 6 interest rate cuts in 2024. At least that was the expectation at the time based off the information that was available. And here we are, it's now almost the end of April, and we're still waiting for that first rate cut. So I think, for me, this is just another reminder that forecasting in general is really hard. And forecasting something as complex as the direction and timing of interest rate movements is really hard to consistently get right. These economists are smart, hardworking, extremely well-intentioned people, and I think that their forecasts and their processes are probably very, very sound. And I think it just speaks to the level of difficulty that's involved in forecasting something like this. So here's a chart that kind of makes that point. And I'll link to the website that includes the data, the source data for this chart. But pay attention to the green bars. And basically what I did is I went back at the end of the year to look at what the expectations were for interest rates in 2024, particularly at the end of 2024. The Fed funds, or the Federal Reserve meeting, December 18th, 2024. This chart outlines the likelihood that rates would fall in different ranges. So at the end of the year, we were still kind of in that 5.25% to 5.5% Fed funds target range. That's still where we are. And the general consensus was that we were going to have some pretty meaningful cuts over the course of 2024. So you can see that represented here in these green bars. If you add up all those green bars, particularly the big one, the big bars all the way to the left, you can see that the likelihood that the Fed would cut by 1% or less this year was pretty much a 1 in 40 shot, like 2.5% chance. So that was the expectation at the time. If we fast forward 4 months, here we are now. This data is as of April 19th, I believe. You can see how quickly expectations have changed. So those orange bars represent the expectations, the current expectations, or the likelihood that interest rates will be in different ranges at that December meeting. And so you can see how far they've shifted to the right, or in this case, higher. Again, I think the main point for me is that forecasting things like interest rates can be very, very difficult. All right, I included another chart in the blog post from that Wall Street Journal article that I mentioned earlier. and I'll show it now. And this chart displays, again, different rate forecasts at different points in time. And so the first thing that you'll probably see is that red dotted line. And that red dotted line represents what those economists that were surveyed by the Wall Street Journal currently expect for the path of interest rates, and specifically the Fed funds target rate, over the course of the next couple of years. Now, look down toward the bottom of the chart. This is what those expectations looked like about 3 years ago, almost 3 years ago, in July of 2021. At that point in time, the information that was available to us was dramatically different. Inflation hadn't really started to spike yet. And so the forecasts called for rates to remain below 1% for a really long time. Then you look toward the middle of the chart, and you see that middle dotted line. These were the forecasts in July of 2022. So as more information became available, you started to see inflation rates start to move higher. Remember all the concerns over supply chains, things of that nature, the post-COVID stimulus making its way through the economy, and economists started to forecast higher interest rates for a little bit longer, but then rolling over and coming down. And then you can see kind of how those Fed funds target ranges have evolved over the last 3 years. So interest rates have continued to climb much higher than originally predicted. And now we're at the point based on the information we have, you can kind of see what those forecasts look like for the next couple of years in that red dotted line. Again, I think the takeaway for me is that making investment decisions based on an interest rate forecast is really, really challenging. And I think you've got to get the timing right, you have to get the call right, and you have to get the investor behavior right. And to me, that's a lot of stuff that really has to go in your favor in order to get rewarded. It's hard. And for a lot of folks, I think it's too hard. So an old colleague of mine, to kind of paraphrase part of his philosophy, it's own businesses that can perform in a variety of different environments, a variety of different economic backdrops. Because if your investment thesis relies on a very specific outcome and you're wrong, the penalty can be pretty severe. All right, I wanted to highlight one other kind of trend from the last few years. And investors have a variety of different ways that they can express beliefs around the direction and path of interest rates. And one way that folks typically do this is via flows into and out of bank loan funds. And Morningstar has a category for bank loan funds. And just at a very high level, these funds typically invest in loans that have floating rate interest payments. And they historically have performed well in rising rate environments. And as rates fall, that can be a more challenging environment for bank loans. Most of these are a little bit more credit sensitive quite a bit more credit sensitive than interest rate sensitive. And so you can see kind of how flows have evolved as interest rate expectations have changed. This chart shows a couple different things. First, the monthly flows into and out of bank loan funds since the beginning of 2021. The green bars represent months in which money was coming in. The orange bars represent months in which money was coming out. And that black line shows the total net flows from start to finish. And so you can see investors started flooding into the space, into these bank loan funds throughout 2021 and into 2022. And then that all happened as belief started to set in that rates would be moving higher. And so to try to protect, this is historically what happens pretty consistently in these types of environments when expectations for rates are that they move higher, money comes into bank loan funds. Again, they tend to benefit in that type of a scenario. And then as investor behavior or investor, beliefs around the path of rates changes and expectations are for rates to fall, money typically comes out of these bank loan funds. And so that started to happen in mid-2022 until very recently. Like the last couple months, there have been a little bit of money that's come back into these funds, but by and large, the trend was money flooding in for the first year and a half or so, and then money coming out. And during that inflow period, investors added about $57 billion in new flows to these bank loan funds, and then it can leave just as quickly. So over the last year and a half, give or take, about $48 billion has left these funds. Now, I think it's also important for me to kind of look at the returns, and bank loan funds in general have performed really well relative to other fixed income or bond asset classes during this time frame. From January 2021 through the end of March, the Morningstar category average return was about 16%. And that's pretty darn good compared to some of the more interest rate sensitive bond categories like intermediate core bond, which the category average return for funds in that category is negative 10%. So there was a huge spread. But the other piece is the timing of flows. So a lot of that money started to come in 2021, but it really didn't pick up steam until later in the year. And then as money has come out, those funds have still actually performed relatively well. So the dollar weighted return, which basically takes the timing of those flows into account, was just 2.5% during that same 2021 through March of 2024 timeframe. So the investor experience was considerably lower than what the funds themselves returned during that time frame. This kind of speaks to the idea of investor behavior, and getting the timing right is really, really challenging to consistently get right over time. All right, so at the top of the video, I mentioned that this is not financial advice. So keep that in mind here. For me personally, I think trying to make economic calls and reposition investments to benefit from changes in the economic environment is really, really challenging, especially when those moves are short-term in nature. So if you share that belief, here are a couple other ideas or a few other things that you might want to consider instead of trying to get the next interest rate move call correct. The first thing I would suggest is revisit some of the risks in your portfolio, and specifically look at how the different investments that you own move in relation to one another. Are they all moving up at the same time? Are they all moving down at the same time? If so, then they're probably exposed to some of the same drivers. And if your goal is to have a more diversified portfolio, then perhaps you're not exactly positioned the way that you intended or the way that you would want to be. So understand some of the risks that drive the movements in your portfolio and make sure those are intentional. That would be the first suggestion that I have. The second would be to maintain plenty of liquidity. And this is particularly true for folks that have short-term goals or short-term spending needs within the next 2 or 3 years. If you have some of those cash outlays that you are planning for, make sure that you've got, or I guess you might want to consider having plenty of capital set aside in a type of investment like money market funds these days are yielding still considerably over 5% in a lot of cases, where you have a lot of liquidity. There's generally safety. Safety is a word that I use not to make any type of promissory statement, but generally the asset value is very, very stable, and you can have access to those funds whenever you need to. So you're not going to be exposed to, or you shouldn't be exposed to, significant drawdowns, regardless of what's going on in the broader economy or market. And then the last piece that I think would be worthwhile is just kind of revisit the plan. We're big believers in having a long-term plan for financial planning purposes, but also we think the investing side of the equation gets a lot easier when you're able to invest intentionally. I think it promotes consistent behavior and perhaps supports the idea of making fewer emotional decisions based on whatever's in the current headlines. So hopefully this is helpful. Again, we think that forecasting interest rates is a reasonable goal for a lot of folks because of the importance that they play in pricing assets, but it can be really, really challenging to consistently get that right. So just keep that in mind when you're reviewing your investments, when you're reviewing your portfolio in total, and try to understand exactly how all those different pieces fit together to accomplish the things that matter most to you. If you have any questions, please don't be shy. Reach out to the Divvy Wealth team. And again, if you'd like to follow along with our views and thoughts on markets and investing, best way to do that is go over to divvywealth.com. That's DIVVI wealth.com/blog, where you can sign up, or head over to YouTube and search at Divvy Wealth Management and subscribe to our channel there. Thanks again for watching. Have a great day.